Today, we'll be covering 10 investing mistakes that Peter Lynch detailed in a valuable and rare keynote speech given in 1997. The principles he pulls from are still all very applicable to our day and the financial system we find ourselves in. As an ultra-successful investor and respected figure in the financial world, we would all do well to heed his warnings.
This is what I'm going to cover today. It should be on your desk. These are the key points that I've been using for 25 years. I think they're true then. I think they're true today. I think they'll be true in 25 years. And I think that's what successful investing is all about.
You're going to want to stick around for the whole list today because we're going to hear some great insights from Peter, such as the average rate of how high a stock will go within a year, as well as emotional regulation strategies for holding on to those sweet, sweet profits. And just to tease you a little bit, my guess is that all of you will find mistake number 8 familiar. We'll cover how you can avoid that one and much more. So without further ado, let's dig into these 10 investing mistakes that could absolutely ruin your profits. Number 1, not knowing what you own.
I can't believe how many people own stocks and they couldn't describe to an 11-year-old in 2 minutes or less why they own this thing or what it is. If you actually pin them down and you put a whip to them, they'd say the sucker's going up. That's the only reason they have for it.
This is perhaps the most obvious, yet the most often made mistake. When you consider the state of retail investing today, it is safe to assume that this is a bigger problem than ever. All across the internet are analysts and influencers with a wide spectrum of investing experience. These people on your screen are great at hyping up stock, but what do you actually understand the story and the operations of the company you own?
People buy this stuff. I mean, I buy stuff like Dunkin' Donuts and Stop and Shop and CVS and made money in all those. But I'm telling you, people don't do this. And I'm talking sophisticated people, unsophisticated people. They don't know what the company is, what's the story. And it's very important to know it because it doesn't always work. And you have to keep posted.
When it comes down to buying and selling stocks, you are putting yourself at a major disadvantage by not fully understanding the business strategy, market, product, and other important factors in a company's success. For example, if you're selling a gene editing stock because a treatment didn't make it past clinical trials, someone else is happy to buy it up because of new developments that are about to lift the whole industry higher. The difference is that you are trading based on the news and they're trading based on their expertise in that particular market. To make the most strategic and profitable plays, you should know you're holding inside and out. It doesn't mean that you should stay away from new markets, just remember to do your homework. Number 2, listening and trusting stock market predictions. As much as we would love to have a special S&P 500 crystal ball for guiding our investments, it just doesn't work that way. Lame, right? Despite this, everyone and their dog seems to think they have found their own crystal ball. The fact of the matter is, the stock market is unpredictable due to its own nature.
Now here's a big point. Remember this one. It's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we get a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. I remember in 1982, we had a lot of people in this room around for 82. We had 20% prime rate, 15% long governments, double-digit unemployment, double-digit inflation. I don't remember anybody telling me about that in 1980. I remember anybody telling me about that in 1981. But in 83, I remember they said, well, the economy's bounced back. We're in a recession in 85. In 85, they said we have a recession in 86. In 87, something happened in October 87. I forget what something happened in October 87. Celtics lost 7 in a row. Something bad in 87. They said for sure we'll have a recession in 88. And they said 89, for sure we'll have a recession. And then 90, we're supposed to have the so-called soft landing, which we never had. So I've always said if you spend 13 minutes a year on economics, you've wasted 10 minutes. And
Peter Lynch has been around the block a time or two. That means he has seen analysts and economists of all sorts make predictions that fell through. Even the general public's consensus on the stock market's direction doesn't seem to work out the way it's expected to. People stand to lose a lot of money by assuming that stock market predictions are rooted in certainty when it is quite the opposite.
All you need to know about the stock market is it goes up and it goes down, and it goes down a lot. And that's all you need to know. Again, it'd be terrific to know what's going to happen in the economy, but I deal with facts. If inventories are going up, if copper prices are going down, if room occupancy is going the wrong way, people building too many hotels. I look at freight car loadings when I own railroad stocks. I deal with facts. I don't deal with people tell me something's going to happen in the future. You might as well call the psychic hotline for that stuff. I think you have a better average.
When you're making your moves, don't rely on other people's predictions unless they have a lot of facts to back it up. If you pay attention, you'll notice that many prospective analysts will try to convince the masses to make plays based on a couple of indicators of sorts. In other words, there's a lot of confirmation bias influencing predictions. Stop attempting to predict the market as a whole and boil down the research to a few bare facts. Just like Peter mentioned, he isn't paying attention to people warning him about the freight train market, he's just watching the loading numbers and other details down on the ground. Number 3, thinking you are going to miss the profits.
You got plenty of time. This is true of Sally Mae, it's true of Dunkin' Donuts, it's true of Stop and Shop. People are so insistent, I'm that way too. I have to fight it. They have to buy a stock, let's see, it's now 501. I haven't found a stock yet today. I got to find a stock before sunset. You could buy Walmart 10 years after Walmart went public. Let's say you're a very careful investor. You waited. You said, I don't know if this company can make it. You waited for Walmart to roll it out. You could buy Walmart 10 years after they went public and made 30 times your money. 30 times your money. 10 years after they went public, they're only in 15% of the United States. 1.5. They hadn't saturated the 1.5. You could say, well, why can't they go to 17? Why can't they go to 19? I mean, why don't I take a leap of faith here? Why can't they go to 26? All they did for the next 3 decades was roll it out. You could buy Walmart. If the day they went public, you bought it, you would have made 500 times your money. If you waited 10 years in Walmart, you made 30 times your money. You got plenty of time in this business.
Mr. Lynch's Walmart example showcases a great point. Just because an opportunity seems to be slipping by does not mean that there won't be a good one in the future. The FOMO, otherwise known as the fear of missing out, is strong in the financial community. It's infectious even. It's often the case that you hear about opportunities that are too good to be missed. Naturally, these seem to be time sensitive and require immediate action. Funny enough, these crop up all the time. Sometimes it's even the same stock. Like Walmart, the company has expanded in massive ways for decades. Each time the business made big moves, you could have made big money. Despite this, you could have still made great returns at any point. In fact, many would argue that there are still profits to be made with Walmart stock. The lesson here is that you should be watching carefully for good opportunities because there will always be more. Don't get caught up in the hype and buy stocks carelessly. Now, the 4th mistake that may ruin your profits is this. Number 4, if it's gone this low, it can't go lower.
Here's a good one. If it's gone down this much already, it can't go any lower. I remember when Polaroid went from 140 to about 107, and people said, if you ever get Polaroid under 100, you got to buy it. You just back up the truck, buy the stock. Stock you get to 110, then rally, fall 103, you go 112, go 105. They said, gets under 100, buy Polaroid. Polaroid broke 100, people started buying it, and within 9 months, the stock was 18.
Much like his previous point regarding how true predictions are nearly impossible to make in the market, the story of Polaroid makes a great case study. Here we see the difference between people who trade based on feelings instead of facts. Someone who better understood Polaroid would have seen their downfall coming as the company failed to make the necessary business transitions to stay relevant. When a stock is falling and you get these big green money signs in your eyes, stop and ask yourself, is this stock undervalued or is this foretelling where the stock is headed? Just because the price has been trending downwards for a minute doesn't mean it's due for a rebound.
It can keep going. In fact, I tried this out. Kaiser Industries, I was a new analyst at Fidelity, and we were about to buy the biggest block ever at Kaiser Industries. The stock had gone from 29 to 17. We're about to buy the largest block ever in the history of the American Stock Exchange. We bought, 10 or 15 million shares. At 15 3/4, I said, my God, the stock's gone from 29 to 17. How much lower can it go? So we bought this enormous block at 15 3/4. So I called my mother and I said, Mom, I guess stock at Kaiser Industries, it's 10. So about 3 months later, I said, you ought to buy this. It's gone from 29 to 10. How much lower can it go? Well, it went to 9, it went to 8, it went to 7, it went to 6, it went to 5, it went to 4. Now, fortunately for me, this happened very rapidly, or I'd be working at the Stop and Shop bag and behind the line instead of Fidelity. So fortunately, this was compressed in only about 6 months.
Number 5, if it's gone this high, it can't go any higher.
There's a corollary to that that's even more dangerous. If it's gone this high already, how can it possibly go lower? Higher, sorry. That. Philip Morris, adjusted for splits, sold for 12 cents in 1951. And then it goes to 60 cents in 1961. So it goes up fivefold, and you say to yourself, how much, this it never sold for that, but just for splits, you say, how much higher can this go? It's gone up fivefold. They missed the power of Marlboro. They missed there's 220 countries in the world. They missed the cash flow of the company. They missed everything. This stock was a 100-bagger after going up fivefold. But people sold it just saying, how much higher can it go? Can't go any higher. They did the same at Home Depot. They did the same with Toys R Us. I did the same thing at Toys R Us. Just saying it can't go any higher, it's gone this much already, that's very dangerous, and don't use that one. And it's a very bad thing to do.
This is essentially the polar opposite of mistake number 4, and the duality of the two are apparent when you compare them. Both mistakes are made because investors fail to base decisions off of the real numbers and actual market outlook. Instead, people will see a balloon heading upwards and assume that it's peaking. There are good reasons for people to make assumptions like this, and most of the reasons are because they have seen stocks shoot up and peter out many times. Again, this is trading based on emotion and past experiences. You should always be looking at the raw numbers to decide if there's potential for the stock to go higher. Number 6, assuming that they always come back. This is another classic line that you've heard before many times, we're sure. This is a common phrase that is loosely based in reality. Certainly, many stocks that are beaten down tend to make their way back up slowly over time. Regardless, making trades based on catchphrases is a recipe for disaster. In fact, this is one phrase that you definitely do not want to base your trades off of. While it may come back, you could very well be throwing your money into a bottomless pit of bankruptcy. If you think a stock can make a comeback, you better understand the company through and through.
They don't have to come back, but they say eventually they always come back. Not true.
Number 7, thinking you deserve profit.
This is a very important rule. This is one of the key rules. The stock doesn't know you own it. Remember that. You could be a miserable person. You could have, never helped anybody, never done anything right, had 67 spouses, never done anything right. If you own Coca-Cola the last 50 years, it's gone up 300-fold. You could be the greatest human in the world, help Special Olympics, help the mentally challenged, help poor people, help AIDS people. If you own Bethlehem Steel, it's lower than it was 30 years ago. It's not your fault. Don't take this personal, But people treat stocks sometimes like their grandchildren or a puppy. I mean, they think the stock knows who you are.
As hard as you've worked to build your trading prowess and understanding of the market, you aren't actually owed anything. Finance is as lucrative as it is unforgiving, and nothing makes your trade special when compared to others. Don't let your own ego blind you from avoiding dumb decisions. Don't let people online convince you that a revolutionary trade, like buying out short sellers on GameStop stock, is more likely to turn out in your favor. The numbers don't care about your feelings. Speaking of, if you miss GameStop, you want to remember this next point. Number 8, regretting trades that you didn't take.
Here's a very dangerous one. Look at all the money I've lost. I didn't buy it. People do this all the time. They say, I didn't own Blockbuster, I didn't own Home Depot, I didn't own Toys R Us. Eric, it was very nice to say some nice things about when I came up here, and Manny has been nice to me. I literally, one of my books listed on 2 pages, in the 13 years I ran Magellan, I listed, I think about 200 stocks, A through L, on the New York Stock Exchange. They went up tenfold or more that I didn't own while I ran Magellan. I had owned lots of stocks. I listed 200 stocks A through L. I stopped at the letter L, and I didn't own any of these shares. They went up tenfold or more, and I was able to do okay with Magellan. And people worry all the time about missing Microsoft, missing Western Digital, missing United Airlines. They spend all their time worrying about stocks they miss. You cannot lose money in a stock you don't own. That's a very important. The only way to lose money is buy a stock, have it go down, and sell it. That's the only way. And I swear that people, their spouse has to cut out the newspaper in the morning, cut out the C's, and the person will look at the Amazon. Oh my God, Microsoft's up 3. I was going to buy 1,000 shares of Microsoft. I lost 3,000 Microsoft last night while I was sleeping.
Focusing on the price jumps you missed will only wear you down emotionally, and for no good reason. There are plenty of great trading opportunities every week, but it's not possible to catch them all. Spending your time regretting the stocks that you missed out on will only make you more likely to jump the gun on another trade. Your time and attention is valuable. It is truly a waste to spend either of them on trading opportunities that are already in the past. You are certainly better off spending your time and attention researching your next future move. Number 9, assuming that if a stock goes up, your theory is correct.
Stock has gone up, I must be right. Stock has gone down, I must be wrong. I'm convinced that people do this all the time. They buy stock at 10, they buy a little bit of it, it goes to 13. They now say they don't know anything more about it than they knew when they bought at 10. They have no idea what this company does. It's gone to 13. Now they take a second mortgage in their house and buy it at 13. The best thing that can happen for us is the stock go directly from 10 to 4 for these folks. It's going to go to 4 eventually, but it goes to 13 in the middle. They're convinced now. They bought 100 shares at 10. Now they buy 20,000 at 13. And all the fact is the stock went from 10 to 13 is it went up.
When you have a theory about a stock going up and it comes true, it's hard to resist doubling down. When a stock has good upward momentum, the only thing you want to do is increase your profits. Unfortunately, if a stock is going up, the clock is already ticking. If you need more convincing, listen to this heavy stat that Lynch drops.
The average movement of a stock in the New York Stock Exchange this century, between its high and its low, has been 50%. The average stock in the New York Stock Exchange. That means the stock started the year 20, sometime during the year sold 16, sometime during the year sold at 24, might have finished the year 21, might have finished the year 19. The average range of a stock in the New York Stock Exchange is 50% in 12 months between its high and its low. So stocks go up and down a lot within a year. And say this stock is going up means you're right, doesn't mean a damn thing. So don't buy often on that one. That is not a good one.
And finally, the 10th mistake that may ruin your profits is this. Number 10, the stock is cheap. How much could I lose? The answer to this burning question, all of it.
Here's a great one. It's $3. How much can I lose? This is a great one. You see, get out. This is. I don't have a computer and I can't do high-level math, but just do this one. So let's say your neighbor buys $10,000 of a stock at 50, and the stock's now 3, and you put $25,000 in at 3. If it goes to 0, who loses the most? A lot of people cannot answer this question. If you put $1 billion in at 3, you can lose $1 billion. They blow taps in lots of companies every year. They can go to 0.
There's always a chance that you could lose it all. This doubles as another mistake that many investors make for their first few and often last few trades. Not understanding the amount of money you could actually lose makes huge financial problems for people. Investing more than you can afford to go without is the perfect way to put a massive burden on your shoulders. So no matter how cheap the stock is, always be prepared to handle a bigger loss than you could expect.
These people have been through recessions, depressions, world wars. They've seen it all. There's a great expression in the textile industry. It's always darkest before pitch black.
We're sorry to end this on a depressing note, but hopefully you got a laugh out of it. It's important to take the harsh reality of the stock market with a touch of humor. If this video was helpful, entertaining, or both, please leave us a like and subscribe. Now, if you're in the money-making business, I recommend you watch this next video. It covers the story of how Ray Dalio started with only $300 and made it into $14 billion. It's truly an exceptional story. See you in the next video.